traders, when they put on that one individual trade, often become obsessed with that one individual trade and trying to make that one individual trade profitable. It's super important for traders to not have a random approach to risk management. I cut my losers at 5%, or I do this at this percent. We're not trying to trade today, tomorrow, this week, the next 6 months, the next year. Ideally, this is like decades. We want to be trading for 30, 40, 50 years.
Yeah.
So if you build these bad behaviors of really big portfolio drawdown, but I called it right that time, I'm good now.
It bounced back and you get saved.
And then you're good. You're like, man, I can call this. I know what's going on. And then sooner or later, risk will be realized.
Yeah.
And then you'll have that scenario where it falls down 20% again. You'll do the same thing, but instead of stopping at 20, it goes to 40. And now you have a big problem. When I was in my early 20s, I made what I called a millionaire roadmap because that was my goal. Okay. And to everybody's dismay, the primary input in this roadmap was aggressively saving money. So that's what I did in my early 20s.
This is very different from, I think, stock trading. I think stock trading, most traders I know have 1 to 5 strategies that they stick to. And they see the opportunity, then they apply, let's say, number 2, number 3 to that set opportunity. So, but you're saying is in options trading, you kind of maybe have more than how many sets of different strategies, and you kind of adapt and change and revise it based on your risk and based on the opportunity. Today we have an exceptional guest, Erik Smolinski, a Marine veteran turned millionaire options trader. With over 16 years of experience, Erik achieved the remarkable feat of turning $2,000 into millions through risk-averse trading strategies. His journey is nothing short of inspiring. Seeing the financial burden on his mom, who single-handedly raised him, he started hustling multiple gigs, such as woodcutting during his high school days, and discovered stock trading as a way to generate compounding wealth. Erik also served in the Marine Corps, but his obsession with trading eventually led him to become a full-time options trader. Unlike many other options traders we know, Erik stands out for his really strong emphasis on risk aversion and meticulous risk management styles. In this episode of the Humble Traders podcast, Erik will break down common myths about trading zero DTE options and share his insights on how to approach zero DTE options with proper risk management and consistent trading process. In this video, you're going to learn risk-averse trading strategies, how to master risk management from the portfolio level all the way down to strategy levels, how to systemize your trade preparation process and identify market opportunities using data tracking systems, the Dunning-Kruger Effect behind Erik's biggest trading loss, and how to avoid common pitfalls in options trading. The Humble Traders podcast is dedicated to help up-and-coming traders to learn from the extraordinary mindset and experiences from the pros. Don't forget to give us a gentle tap on the like button. And now let's get ready for a wealth of knowledge and information from Erik Smolinski. All right. Welcome to the pod, Erik.
Thank you for having me. Blessed
You
to be
are
here.
officially our second options trader on this pod.
I'll take it. Yeah, it's good. Gotta get some of the options people out here.
Yes. You gotta burst the myth of the zero DTE and all that risky business that a lot of the options traders talk about.
I tell you what, it absolutely can be risky business though. The last couple days trading zero DTEs in SPX, it's been okay, but not great. Okay. And then today was better. So that's how it goes. It ebbs and flows.
I was telling you earlier that when I first started trading, I started with stocks and I found some success and immediately jumped to options thinking that, if I'm a good stock trader, I can make even more money with options. And that's how I blew up my 3rd or 4th account with options. And all my gains from stock trading blew up. So I'm after that, I quit options.
I don't blame you. Three or 4 in, I don't blame you at all.
Yeah. So definitely teach us and obviously me, myself, and my audience more about zero DTE later on.
Sure.
But I would like to hear more about your story of how you got into trading and more specifically options.
Yeah, for sure. So I started trading back in 2007. So I was in high school. And essentially, I didn't grow up with a bunch of money. I grew up pretty poor.
Okay.
And I had a teacher that he saw that I was working a bunch of odd jobs. So I used to like split wood. I worked at a bowling alley, sold Christmas trees. I was doing everything I could because I saw what our life was like. And I had a single mom. And you can kind of see the pressure of not having money on a parent trying to raise two kids. So as I saw that, I started trying to find different ways to change the outcome. My mom was really, really good at working hard, so I mirrored that. But my mom was not good with taking capital and making it work for her. So that's essentially I got introduced to the stock market. I had a teacher. He essentially saw that I was working a lot, and he asked me at one point, because he knew my family, and he asked me at one point, he's like, what are you doing with this money that you're making? And I was just like, I'm just saving it. That's all I knew. And he said, well, you should look into investing. Now, I literally never heard the term before. I didn't even know what it was. So I was just like, cool. Where? And and he said, go up to the library. Because this is still, again, back in the late 2000s.
Yeah.
So, or I guess late 2000 before 10 though. So it was like 2007, 8, 9, like that time frame. And in there, like I went up to the librarian. She was a sweetheart. I said, I want to learn about investing. And she was like flabbergasted that one of the kids from my school, because like we walk through metal detectors every day to go to school. It wasn't,
What?
yeah. It's not the kind of place that people are looking at investing. They're looking where the drug deal's going to happen.
Oh my God. Okay.
And so she was shocked, and she walked me around, and she was just like, you can take a look at this book, look at this book. And she didn't know what she was looking at either. She was just finding stuff that she thought. Anyways, I started reading about it, and I came across some of the basic concepts like compound interest. Didn't make a whole lot of sense, but the idea of putting in a little bit of money that turns into a lot of money sounded great. And so at that point, I was like, I need to open an account. Found out you can't open an account. You need to do a custodial account because I was too young.
Yeah.
And then I started putting all of the money that I had scraped together, saved, put it into bank account, sent it over to the brokerage account, and then started slinging trades.
Oh, so you weren't investing at the start. You were trading?
No, it was a joke.
Okay.
I was 100% investing.
Okay.
So what I ended up doing was buying a handful of stocks. And one of the pieces of advice I saw, it was in a newsletter. It was the Motley Fool. And
they've been around for that long.
They had like an actual newsletter. At least in the library that I was at, it was like a paper newsletter. And so I was like flipping through. And one of the things it said in the newsletter was like, buy what you know. Okay. And I was like, okay, well, that's what I started to do. And I was really excited about a company called Apple. I thought this other company called Netflix was really cool because my brother and I would fight over what DVDs were going to get sent to us, because it wasn't like you log in and stream whatever you want. If, you guys remember at the beginning of Netflix,
they sent you like, is it VHS or something?
It was DVD. They sent you DVDs,
okay.
But like you can only pick like 3. And then they sent you your 3, and then you couldn't get any more until you sent them back. And it was like that, like literally moving the physical DVDs around.
That's cool.
So, but that was like revolutionary at the time. So I started buying stocks like that. And then I started seeing a little bit of success early on. And then that's how I found my way into derivatives. I was a impatient teenage dude that wanted to make more money fast.
Okay.
I saw a little bit of early growth, which I was stoked about, but it wasn't enough or fast enough. So
like it was like a couple % or something.
It was pretty healthy on some of the products, but
okay.
I mean, I started with like $35,000 or $5,000.
Okay,
So even like a really solid % return was a small gross dollar amount.
Yeah.
So it just wasn't moving that fast. Once I saw that initial success, though, it kind of just changed the entire way that I thought about finance. So essentially, what I started identifying is I could still work really hard. I could make money from that input, but then I can invest that money, and then that money continues to grow while I'm working, creating more money, right? That's the whole idea of investing or compounding interest and investing in a nutshell, but that was pretty revolutionary to me. I never saw anything like that. And that's how I got started. And that's when I realized that this is probably something that was going to be what I'm going to do. And I didn't have a lot of resources to begin. I didn't know rich people, as you might frame it. So I didn't even know who to ask for help. I didn't know any of that stuff. It wasn't really in my circle. And that experience going to that library is literally what changed everything for me, straight up.
Okay. So you started with investing, but at what point did you kind of start getting into trading options and specifically what, because I understand there's a lot of different styles of options trading. What kind of strategies did you kind of lean towards in the very beginning?
Yeah, for sure. So it was probably about a quarter of investing, so like 3-4 months, and then I found options.
Well, that's quick.
Yeah,
3-4 months.
Yeah, well, because at that point I was aggressively learning. You can ask anybody that knows me. I have a highly obsessive personality.
Okay.
So as soon as I find something that I take interest in, I drop everything, and that becomes like near soul focus for me. So I was literally going to the library every day to go read, and I was finding everything that I could, bringing it home. I was looking at literally like printouts of charts so that I can
back in the days.
Literally to just try to learn as much as I could. So that's when I came across derivatives. And when I first started trading derivatives, I didn't have enough capital in the account to do most things. So I traded things like cash secured puts, which are really cash intensive, but I did it on tiny little stocks that had options, which is, by the way, terrible strategy.
Tiny little stocks, like small caps?
Yeah, exactly.
Oh, okay.
Because that's the only thing I could afford to put the cash up for the cash secured puts. And then the other stuff I started getting into was vertical spreads, which unfortunately, and probably a lot of your audience that do trade options, they might like or dislike verticals. I have a just pure deep-seated hatred towards them now.
Why is that?
It's because they are so alluring. You put up a smaller amount of money, you can get a really good % return on your money. They're defined risk. All of those things sound so good. Who doesn't want that?
Yeah.
Higher probability trades if you're selling them. There's so many like really neat aspects to it. The problem is the concept of death by 1,000 paper cuts. You're never going to make a bunch of money trading verticals, and you're not going to lose a bunch of money either. So it's really difficult to make an effective strategy trading standard verticals, I should say, which would be like $1 wide, maybe $5 wide, that they're really difficult to make work or to make worth your time. And I also think from a psychological standpoint, it sets traders up for failure because you learn early on that you can get these really big % returns. Right. So if you sell a vertical that's $1 wide, you collect $20 and you have $80 in risk. Well, if you make a max profit on that, it's a good % return. You don't have to put up that much money for that trade. Right. So then when you transfer over to other things, you're expecting 20% returns, 30% returns, 40% returns on everything you touch. And I think it just creates like a perverse relationship with risk and reward.
And that's how you first started with a lot of your introduction. Okay. So how did that work out for you?
Didn't make much, didn't lose much.
Okay.
Yeah.
But it's a good learning experience.
Essentially didn't have much to show for it.
Right.
Well, and the other thing I definitely would love to kind of highlight is early on, I didn't do a lot of the things that I talk about now. One of which is have a trading plan. Right. One of which is have a trading log. And that trading log is actually even more important in a lot of ways because it's what quantifies what we're doing in an objective setting. So one of the things that human beings have is kind of like this Goldilocks recollection, where if we think back about something, we remember the things that we liked about it and we kind of forget the crappy parts about it. Yeah. Really dangerous when you're trying to assess your capacity as a trader or investor. You need to be able to objectively say, like, this worked, this didn't work. So as I was trading verticals, I was noticing I was winning all the time. I was just crushing it. I was absolutely nailing these trades pretty consistently. And then all of a sudden, I like looked through my brokerage statements and I was like, I'm not making any money. Like I'm trading all this stuff. I'm racking up these fees and there's just nothing to show for it. So I think that's one of the big issues with verticals. To be clear, I think everybody has to trade what suits their personality and that's super important. But I think verticals can become a problem for people when they're making the leap from having covered strategies like that are, we're spreading off our risk versus uncapped risk strategies. And that risk aversion can kind of follow you until you learn a way to break it.
So you never traded, because, this is when I first approached options, this is how I traded. I traded naked calls and puts. And then sometimes I'll just trade them like a stock because I came from like a stock trading background. And then I kind of eventually eventually enter the realm of zero DTEs and scalping those. 'Cause I think a lot of people, at least from the comments, sometimes I read that, people are just scalping options. Did you ever do that from the very beginning?
A couple things. So the first thing is I think retail traders have to be really careful when we use the term scalping, right?
Okay.
Because from an institutional side, scalping is kind of something that an algorithm does. It's faster than a human can transact at. And they have essentially a frictionless environment, no fees. That's why they can scalp.
Yeah.
For the retail traders, we hear that term. It sounds really good. Fast, small trades, rack up your profits. But I think it sets traders up for failures in a lot of different ways, one of which is this idea of overall friction, cost of doing business.
Right.
So for retail traders, even if you don't have commissions, let's say that you're trading stock, you still are paying on your fills on the back end. And it's tricky because you just don't see it.
Yeah.
But via payment for order flow, your broker is going to bundle all of their orders to try to get paid for that order flow. And that is an indirect cost to your transaction. So anyways, from the process of scalping, I do trade intraday, as I would refer to it as, but I don't scalp in kind of like the pure sense. But it's a much smaller part of my book. It's not exactly the way that I'm looking to weight what I'm doing. The way I think about my portfolio theory is I have a core allocation of my portfolio and a speculative allocation. So core allocation gets a certain amount of money in certain conditions. Speculative allocation, different amount of money, different conditions. And my goal is to derive most of my annual return from the core allocation. I use the speculative allocation to take shots, meaning if I see an opportunity that looks interesting, or if my core allocation is not running as well as it should, it's typically more long deltas, meaning it wants the market to go up. So if the market's going down, I have to trade more speculative allocation to make up the book on those years. So for me, something like scalping is not something I'm explicitly looking to do. If I see something that is having really interesting price action during the day, but the way that I would scalp wouldn't be with long options more often than not, it would be with short options. So it's kind of a different thesis. And the whole premise behind that typically is in the short-term timeframes like that, I'm actually trying to trade volatility, less so much price.
Oh, okay. That makes sense. So you're kind of shorting the premium spikes.
Yeah, that's it. You can think of it that way. Really, if you have a company like a biotech company that just released some sort of trial report and the market's digesting this new information, typically implied volatility in the options chain will spike.
Yeah.
And it offers an opportunity to trade the dissonance between implied volatility and historic volatility.
Okay.
So it's kind of those instances that I'm looking for.
And what kind of risk would that imply? Because I actually I forgot which guest it was. We had a guest who did exactly that on GME back in 2021 when the stock spiked out of nowhere. That's the first breakout. No one has ever seen the stock do that. So he shorted calls on GME, thinking that it's way too volatile. And I think okay, I'm not gonna say his name, but I remember who he was. Yeah, and then
keep him anonymous.
Yeah, but he talked about that. He was like, I ended up with like a 7-figure loss.
Yeah, I bet.
So how would you manage risk on those kind of trades?
So the way I think about it, risk specifically, is that it's managed long before you ever click a button. Okay. The way I think about risk with trading, especially options, because when you trade options, they have dynamic profiles. They move, especially if you sell. If you sell an option, you have an initial margin requirement that if you wait 10 minutes, it might be different. So the way I think about risk in the portfolio really is pretty simple. I start with, what are my thoughts on the market? That is more of an exercise to paint a subconscious part of my brain. Okay. I'm just trying to synthesize information that I either will consciously apply or it's at least a subconscious undertone. So if I think about the markets that we're looking at now, really, really boring overall, but so much emphasis on interest rates. That is such a big deal right now. Yeah. So every time we have any sort of inflation-centered metrics come out, I know the market cares about that. So when we're getting CPI, PPI, like all these different kinds of things. So that is kind of the first level. I want to understand what the broad market is doing, what the broad economy is doing, just to help inform further decisions. Then I step down to the next level, the portfolio level. As I already mentioned, I break out the portfolio into those two different pieces. But before that, I immediately establish risk tolerances for the entire portfolio. So how much money do I get to use at a given point in time? And there's kind of a set scale that I'll use to determine how much things get. Then I look at what is the correlation of the portfolio compared to what I want it to look like. So I use things like beta weighted deltas. This is essentially a tool that allows you to take an entire portfolio of options positions and it puts it into one common language. So for example, if I have a book of 35 trades, some long options, some short options, all different kinds of names, and I beta weight those deltas to something like SPY, and let's say the number I get is 100. Literally all that means is that the entire portfolio is going to directionally behave like it's 100 shares of SPY. So then I make a question to myself. I make an assumption. I say, am I comfortable with my portfolio essentially being similar to 100 shares of SPY? Yes or no? And if you have a really small account, that might scare you. If you have a bigger account, you might say, okay, well, directionally, I'm not using enough right now based on what I think I should be. And then I go through the rest. So I have the overall correlation weighting on the portfolio level. I set things like max drawdown for the portfolio level. It's kind of like a circuit breaker. So, and it's evolved a lot over my trading career because in the beginning, my goal was to aggressively grow my portfolio. And as I was doing that, I had pretty significant success over the years. So now I'm less concerned about aggressively growing it. And I'm more interested in one, preserving capital, but then two, just focusing more of my time and effort on really good opportunities. So just being very selective, essentially.
I see.
So that's kind of the next level of, and the first actual step in managing risk is determine what disposition the portfolio can have, determine what size makes sense for the portfolio, and then to set up circuit breakers based on if I have, let's say, a 20% total portfolio drawdown. That's probably a little light for a lot of people, but just for an example. If your entire portfolio experiences a 20% drawdown, that's a circuit breaker. That means you cut. You start cutting everything. And it's literally to not get into this psychological step where traders are really predisposed to this. There's a study called The Behavior of Individual Investors. It's by Barbara Lena and Odine. You can look it up on SSRN. Side note for everybody, for any of this stuff, like you should take what I say with a grain of salt. Everything should be something you can look up. And anyways, that's what I'm going to refer to now. And in that study, they talk about different wealth depleting habits or behaviors of traders and investors, one of which is called the disposition effect, which is where we tend to cut winning trades too short. We like that sensation, and we let losing trades run. Don't want to realize a loss. It's a big confrontation of the ego. You're now completely wrong. You're justifying being wrong, and you're having to acknowledge it. So going all the way back to the circuit breaker concept, that's why it's so important. Because if your portfolio is down 20%, then you're starting to think like, man, now I need a even larger percent to get back to break even. Maybe this will turn around. I don't think it can go more. And this bartering happens. And then all of a sudden, instead of a 20% drawdown, now it's a 25% drawdown. Or what can be even worse is that if that 20% drawdown rebounds and you're like, I was right. This was good. Because what I like to remind traders is that we're not trying to trade today, tomorrow, this week, the next 6 months, the next year. Ideally, this is like decades. We want to be trading for 30, 40, 50 years. So if you build these bad behaviors of really big portfolio drawdown, but I called it right that time. I'm good now.
It bounced back and you get saved.
And then you're good. You're like, man, I can call this. I know what's going on. And then sooner or later, risk will be realized. And then you'll have that scenario where it falls down 20% again. You'll do the same thing, but instead of stopping at 20, it goes to 40. And now you have a big problem. So that's at the portfolio level. Then I take another click in on risk management to the strategy level. So every single strategy that I trade, I do a ton of research. I've like literally over 30,000 hours looking at this stuff now. And what I do is I look at what the strategies behave as. I go through a process, what I like to call cutting the tails.
Cutting the tails.
Cutting the tails. And the idea behind that is to look at the broad performance of the system and to find the outliers that occur to the downside and to say what happened in these instances. It's a bit of a delicate process because if you try to manage too much of your losers, you actually start to have more of them because you get stopped out a little bit earlier than you otherwise might.
I see.
And I go through that process and I define for each strategy based on the profile of the strategy, how I manage risk in that strategy. So for example, if I'm trading something like a ratio call diagonal, which is like a bullish trade, I want something to go up and I'm using leverage via options to trade it.
I see.
If I'm trading a ratio call diagonal, it's typically going to be based on some sort of chart behavior. So if something's been consolidating in stage 2 and I think it's going to move into like a stage 3 breakout, that's a point that I might choose to trade that strategy. So what I'm going to do is apply technical analysis to figure out where I think near-term support for that position would be.
Okay.
I'll figure out where I would want to get stopped out at a reasonable level. And then I'll figure out what the size of that loss is based on my desired position sizing and see if it makes sense. So for example, if I have a $100,000 portfolio, I look at this trade and at the point that I would want to get stopped out at, it's like a $40,000 loss. Way too big of a drawdown on one individual trade. So I need to make some choices. Either I need to size the position down or I need to scoot the stop up, accepting the fact that I'm probably going to get stopped out early. And you have to figure out what's right, obviously, in the individual instance. And that's at the strategy level. And then the trade level is kind of what I was just talking about, looking at the individual opportunity and then figuring out what risk management essentially applies to that. But I think to summarize all of that, it's super important for traders to not have a random approach to risk management. I cut my losers at 5%, or I do this at this percent. If you try to use a hammer for everything you come across, you lose the beauty of options, which is that they're so adaptable. They're strategic investments. So the way that I manage my risk in a breakout strategy to the upside, like ratio call diagonals, is completely different than the way I'm going to manage risk in zero DTEs, which is way more of a quantitative play. Yeah. I'm trading the persistence of variance risk premiums over time. That's a numbers game, essentially. So I need to not get blown up when it doesn't work out, but I need to have enough occurrences so that I get exposed to it. So the way I manage risk in those two different things is completely different. So the way I would think about that, backtest what you're trying to do and see if it makes sense. I have another thing that I'll tell people is make it make sense. So if you're backtesting something and you're applying the same thing that you're doing everywhere else, just because it's what you do everywhere else, you might find that it doesn't make any sense whatsoever.
Oh, interesting. This is very different from, I think, stock trading. I think stock trading, most traders I know have 1 to 5 strategies that they stick to. And they see the opportunity, then they apply, let's say, number 2, number 3 to that set opportunity. So, but you're saying is in options trading, you kind of maybe have more than how many sets of different strategies, and you kind of adapt and change and revise it based on your risk and based on the opportunity.
Yeah, I think that's kind of fair. Now, realistically, the number of strategies I run is pretty small. So I run what's called a covered strangle, which is generally bullish leaning. Ratio diagonals, I can trade those to the upside or to the downside. I trade short straddles and strangles. That's typically for variance risk premium, for earnings plays, for biotech plays. Those 3 strategies make up the vast majority of what I do. I have other things that I'll tinker with for sure, but that's the majority of what I'm doing.
Do you ever trade those neutral strategies?
Definitely. But the thing is for options traders, I think the concept of neutral is also broken. Because I think a lot of options traders, they think that if I'm trading neutral, I don't have to make a decision. And they're using this idea of being neutral to offload the process of making a decision. And I think it's bad. So when I'm trading a neutral strategy, I'm actually not neutral. I'm making a decision still. But my decision in that case is I'm trading the idea that implied volatility will be higher than realized volatility. So I'm actually trading the behavior of volatility as compared to not having an opinion on price.
Oh, interesting.
Yeah, kind of different. Yeah, I find because I find traders all the time. We try to offload decisions. They're hard decisions. You have to figure out what you're gonna do with all your money, and you're nervous about losing it. So we try to find these little tricks, if I sell an iron condor that's 60% chance of winning, that's a great thing, and but I'm neutral. I don't really have a feeling if it's going to go up or down. So I'll do this iron condor. And it's like, that might work, but I think that's a tough way to make a living trading long term. And as I've said, that's been my entire game plan for this since as long as I can remember, is I wanted to become a millionaire before I was 30. And I wanted to have an exceedingly consistent approach to trading. So none of my years except last year have been stellar. I've had decent years. My best year before last year was 52%. And I did an article actually with Business Insider. We were talking about kind of the way that I think about trading. And this exact thing came up because I watch pretty carefully the US Investing Championship. I don't know if you're familiar with it.
No, I didn't know that existed.
You have to look it up. It's one of the coolest things.
Okay.
And there are people that are competing in a championship, and it's every single year. And you can see the performance of these people. And some of them are institutions, some of them are individuals. And you'll find that, like, again, I perform well, but my goal is always to be more consistent. There's people on there that are literally returning 300% to 600% a year. And it's typically not consistent though, right? It's a championship. So my underlying hypothesis has always been when these guys are joining the championship, they're joining to do as best as they can that one year. And that might not be reflective of their standard performance or whatever.
I see.
The main point is that people can pursue different objectives in trading. And for me, I highly valued the ability to make a certain percent return on my account year over year. I actually counted on it. And it's because when I was in my early 20s, I made what I called a millionaire roadmap because that was my goal. And to everybody's dismay, the primary input in this roadmap was aggressively saving money.
You wanted to save to millions.
The idea was to continue to invest, but the only way that I could make this thing work from my starting point was to aggressively save. So that's what I did in my early 20s is I focused on three things. First one, aggressively save. The second thing is expand my income. So when I was in college, I was doing things like buying broken cars, fixing them, and selling them. Make a little bit of money. I can now put that in the trading account and trade it. And I looked for all of those kinds of opportunities. So save, grow your income, get better at investing. That was the game plan. And I used 15% per year as my model. So I used a compound growth calculator and I said, where do I land in different amounts of times given different amount of money? And I essentially played with it long enough to figure out where I needed the numbers to be in order to land where I wanted. And it boiled down to those three things. I needed to aggressively save to have a high average monthly savings over that time frame. And I needed to perform better in trading than standard market benchmark at the time, which is like 8 to 10%. So that's why 15% was my target, because I felt that it was low and achievable enough that I could consistently do it, whether it's up year or down year. But it's something that gave me a little bit of room for error that if I missed it a year or two, then it wouldn't completely derail my roadmap. Fortunately, I've pretty much always surpassed that after maybe 8 years of trading. So my first 5 years were pretty slow. My first 2 years were slightly negative. Year one and year two, they were down. The worst down year was like 4%. And I think year one, I was down like 1 and change. It's because I didn't
4%, that's nothing.
Yeah, it's because I didn't want to use a lot of money. I was super risk averse.
I see.
Yeah, and that's actually another problem that has taken me a long time to work around is risk aversion. It's really, really difficult because I always knew that I was going to get to a point where my mom, she's a contractor. So she doesn't have a 401k. She has no retirement.
Right.
So I always knew that there was going to be a point where I needed to be ready to help her because I knew she had no savings. And so that's why I set the millionaire target for me. It's not because I thought $1 million was cool or anything. It was a round number, to be clear. But I wanted to make sure that I was at a spot that I could help her. And that's essentially what I was working towards. So making sure that I had a really high efficacy way to get there was my entire target.
Earlier, you mentioned that you didn't used to have a trading plan, and now that's something you do for all your trades. Could you walk our audience through kind of your process of planning for your trades from, I guess we'll start from idea generation and then plan for those trades and actually execute it?
Yeah, for sure. So idea generation, I actually think is pretty simple when you break it down to its core concepts. And this is actually a mistake a lot of options traders make, where if you trade options, you start trading options, you're like, oh, I trade vertical spreads.
Okay.
And I always, think to myself, like, why? Like, why do you trade vertical spreads? Why don't you trade something else? And part of it is because I hate vertical spreads, but part of it is I'm trying to help them identify a problem. The problem is you're picking a structure, an option structure, before anything else. And to me, the very first step is to figure out what mechanism you're trying to make money by. So, for example, if you day trade stocks, the mechanism you're trying to make money by is the directional movement of an underlying.
Yes.
So your edge is the ability to predict direction and manage your risk well enough to have positive expected return. That's where it starts.
Okay.
So with trading options specifically, I start from that first point. How do I expect to make money? Am I going to be directional? Do I think that there are persistent themes where implied volatility is high over realized volatility, which is well documented? You can find variance risk premiums, what that's called. You can find it everywhere. And I start there. I have this idea. Let's say directional trading, probably a little more appropriate to most of your audience. So from there, in my world, there are 3 strategies that apply to that. The first one is long stock. Pretty simple.
Oh, just buy the stock.
Just buy the underlying.
Okay, yeah.
Yep. That's a choice. And the reason why I emphasize that is because sometimes options traders get too obsessed with just trading options that you kind of forget sometimes you can just trade the underlying and it might make sense.
Okay.
The next choice for me would be a ratio call diagonal, which is kind of a leveraged play to the upside. And the other approach that you could use would be like a short put, a naked short put, where essentially you're selling a put, collecting a credit. And the way I decide between those really comes down to what does the opportunity look like? So going all the way back to the original question on idea generation, I first start by defining what mechanism am I trying to make money from? In this example, I'm trying to make money from the directional movement of stock.
Okay.
The next step, I need to figure out how do I determine if I'm good at determining the directional movement of stock. How can I possibly figure that out? Bunch of different ways. What I chose to do was, one, spend a lot of time studying old stock charts. Then I started getting into paper trading. So what I do, but it's not standard paper trading where I'm doing it in like a platform. I actually have an Excel sheet and I build a tracking mechanism for me. Again, because one of the things that traders that aren't organized lose is all of the data points of their experience. Okay. So you might think like, oh, I'm going to use this moving average breakout strategy. And as soon as price breaks above the 50-day moving average, I'm going to buy. I'm going to hold and follow that trend until it falls below the 22 moving day average. Sure, sounds great. Try it. But as you recollect what it actually went like, if you don't track it, you probably will think, yeah, I was right quite a few times. Let me try this thing with real money. Yeah. And it might work, it might not, but it might not be the right approach. So what I do is I determine how do I measure whatever the effect is that I'm trying to make money from. I want to be directional. I need to figure out how to measure direction and do it well. So for me, for the directional strategies, I typically apply kind of standard CAN-SLIM-esque technical analysis. I don't know if you guys are familiar with CAN-SLIM.
I'm not. Sorry, what is that?
Yeah, it's kind of like a William O'Neill, Stan Weinstein approach. It's using typically smaller stocks, but they have like a set of criteria that they're looking for essentially. And but when it comes to technical analysis for a directional strategy, I really believe that keeping things simple and measurable tends to work better for me. Okay. So if I'm trying to trade something to the upside, depending on the time frame I'm trying to trade it to the upside, I'm looking for something that's moving in the direction that I want. I'm looking for moving averages that are ascending. I'm looking for a consolidation period that then results in a breakout of some sort. Okay. So as I'm codifying all of these things I'm looking for, now to find opportunities, it actually becomes pretty simple. You just start scanning for those conditions.
I see.
And that's exactly what I do on a daily basis, is I run through series of scans to see what's popping up that applies to this specific thing that I'm looking for. And I do that for all of my strategies with what they need specifically. Because, for example, if I'm trading 0DTE SPX options,
Okay.
I don't really care what a 50-day moving average is.
Right.
Doesn't matter at all. That's not what I'm looking at. So I need to codify for the 50 or for the 0DTE SPX strategies. How do I make money? I make money when the implied move is greater than the realized move. That's how I make money.
Okay.
So how do I codify that? And I look for the persistence of implied versus realized volatility. Measure that. How good am I at measuring that? Okay. So then I can scan for that to see if it exists or not.
Interesting. So do you track everything on a spreadsheet?
Yeah.
Is there specific tools you use to help make your tracking easier, or just all manual entries?
No, well, it depends. So most of my research, like the broad research, like say, for example, if I'm trying to assess how effective the moving average strategy is, like I'm not doing that manually in Excel. I'll run that through, I bought a lot of data from the SIBO. And I have like minute level, intraday, full Greeks data on a bunch of different underlyings. And for those that are curious about that, I don't want to get your hopes up because it really is like super expensive.
Okay.
So unless you're ready to like fork out a lot of money for that, it's easier to use like backtesting software of some sort that you like, or go through a broker. Just a caveat for everybody. I don't want to send them out there looking for something. Then when you realize that, it's a lot of money.
Okay.
So, but for testing things like that, what I'm looking for is how can I test a ton of information quickly? So I use Python. And I had a friend essentially help me learn how to build a working relationship with Python so that I can create different rules. And now with ChatGPT, literally anybody can use Python. And I would say, okay, as price crosses above the 50-day moving average, what's the average return? What's the average duration before it falls back under the 50-day moving average? What's the total move up and down? Like all those kinds of things.
I see.
And then I piece them together to create a strategy. So that's exactly how I research what makes sense. Now, when I'm entering trades, that's done manually in Excel. And it's done manually very purposefully because I truly believe it's important, at least for me, to be intimately tied with each what I've already deemed important element of the trade as I'm making the decision. Because the way that I build my trade log is it's not like one sheet for everything. I have a different tab that applies to each different strategy because we talked about the different strategies need different things. And even that process of building a trade log is painful, highly educational, because you'll find, again, for the 0DTEs thing, maybe in the beginning, I'm tracking something like how much the price is above the 50-day moving average. And I might track that in the beginning because I think it might be important. And then as I run a bunch of trades, I start realizing, like, why am I tracking this? It's not doing anything for my ability to predict the efficacy of the strategy. So then I stop tracking it. But the only way I know that is by going through the process.
So you essentially, for each strategy, you have, I guess, different sets of indicators, and then you scan for individual stocks or, opportunities with those set of parameters, and then you pick at the opportunity and you apply the strategy.
Yeah.
If everything aligns.
Yeah, that's one of the common ways that I'll enter a trade. Essentially, the way I look for opportunities is actually pretty simple. I look at the market first, see what I think. I look at the portfolio. I see, do I have trades that are coming off that I need to replace the risk for? Do I have trades that I don't like and I need to take down because they're not doing what I want?
Yeah.
And so now there's kind of like two offshoots that come from this, again, in my brain. There's a portfolio-driven need. So let's say, for example, the portfolio is running short deltas, meaning it makes money when the market goes down. But my disposition is slightly different, and I actually am bullish at that time for whatever reason.
Okay.
That tells me I need to add long deltas. So now I know what I'm looking for. I'm not looking for 0DTE SPX trades. I'm looking for long deltas.
I see.
That's one offshoot, portfolio-driven need. The other offshoot comes from what I call opportunity-driven. So as I'm just I look at the markets every day. So as I'm looking at things like, oh, that looks interesting. Maybe I'll, do a little more research there and speculate via whatever strategy makes sense there. So the portfolio-driven need, I already know what I need to add, and I'm looking specifically for something that fits that mold. Opportunity-driven means I'm just walking the street, seeing what looks interesting, and when I find something that looks interesting, I figure out what strategy makes the most sense.
Oh, okay. So essentially, you are dividing your account, or maybe it could be several accounts, your capital into two sections. One, you kind of just like leave it there until you see an opportunity that might be smaller or bigger, and the bigger, what you said, bigger portion is the portfolio, where you kind of you're almost like position trading. Yeah.
Yeah, and I actually like I keep all my capital combined, and it's for a really specific reason, because you gain leverage, right, by doing that. Like as soon as you're over, I don't even know what it is anymore, but it's like $150,000 you get portfolio margin. That helps you a lot as an options trader and stuff like that. But yeah, my main goal as a trader is to assess what I think the market is doing and to figure out how to best interface with what the market is doing. So I don't go out there and I don't say like, oh, I like X, Y, or Z because I like X, Y, or Z. What I care about is, does the market also like X, Y, or Z? And that's what I'm going to trade.
Yeah, you look at the bigger picture first.
Definitely.
Oh, okay.
Yeah, it's, as you can tell, it's a really hierarchical approach.
Yeah. This kind of goes back to when you were talking about from high school and from your experience in the Marine Corps. Like you have a standard process, like an SOP for everything.
That's exactly it. Yeah. I'm glad you used SOP. That's awesome.
Yeah. So you set that roadmap when you were in your 20s?
Early 20s.
And you hit that before. Did you hit that before the age of 30?
I did.
I assume you're over 30
Yeah, I was
now.
at 27. Yeah, I'm 33 now.
Oh, okay.
Yeah, it's a good assumption. I look old.
Yeah. It's the beard.
Yeah, it actually is a lot of the beard.
It's the beard. How's your mom doing now?
She's good. Yeah. So we picked up her expenses a while ago, and she actually turned it around. Like towards the end of her career, she started getting really good at saving, and it was super fun working with her on the problem because I was trying to help her think about obviously the future. Yeah. And that's one of the hardest parts with people when it comes to finance is you have to give them a different perspective because they have to give up the ability to buy something right now, something physical that they can put in their hand right now. And you're saying, well, you'll have more later.
Right.
But they have to give up. Exactly.
Yeah.
But they have to give up something now.
Yeah.
And that process is really difficult for some people. But yeah, we got to a good spot with her, and she's absolutely crushing it now. We were just talking about, she's retired. She's talking about maybe going back because she's slightly interested in like doing something, which I actually think is
otherwise you get too bored.
Exactly.
Yeah.
So I think it's really, really good for her. But yeah, she's crushing it. Oh. Thank you for asking.
I think I heard from one of your other interviews where you mentioned your mom, and like I always have a soft spot whenever people talk about their moms and dads, but I also like that was also one of the driving factors for me to learn trading in the first place. So yeah, my mom is also at a good spot. So like it just makes me happy hearing about it.
It's so awesome. And it gives you a pretty clear target. And it's also another thing that we learned in the military, right? Is like focusing on things not for yourself, but for other people. And it adds a whole different layer to the mission. Because for me, if I was trading just because I wanted to buy a bunch of fancy stuff, it kind of becomes hard to put in like a 12-hour research day, a 16-hour research day. And you're like, how bad do I want, X, whatever it is that you want to buy? But then when you realize that like you're literally doing this for a human being that not only brought you into the world, but gave up everything as a young adult to raise you. My mom worked 2 jobs just to try to keep the lights on. And I remember in my bathroom, like the floor started decaying and I could see through into the basement. And we didn't have money to fix that. So my mom was really embarrassed about it. So she covered it with carpets. And you knew not to step in that spot.
Right.
Because you're like, I'm not trying to go in the basement. Yeah. But the point being is like she sacrificed like everything. So I totally resonate with you on that. And I think it's one of the most purposeful missions somebody could have is to be able to take care of their parents like that.
You also mentioned you were in the Marine.
Yeah.
A while ago.
Yeah. So
was that before or after you started trading?
After.
Okay.
So I started trading in 2007. I graduated high school in 2009. And then I went to college. The Marine Corps sent me to college on a scholarship, so I went in as an officer. Okay. So I did my 4 years. I had a bit of a gap year after I commissioned in 2013 because the Marine Corps was really backed up. So the Marine Corps did this really cool thing where they're like, we're not going to pay you. You don't get anything, but we can't take you right now. So go do something and come back in a year, literally. So you're just like, what the hell, guys? That's not how this is supposed to go. So anyways, I had that gap year. And then essentially all through college, I was obsessing over trading. And that was the cool part about college is I had time, right? You go to classes, but then you have tons of time to look at this stuff. So I started trying to get really, really scalpeled in my research. I was creating a very defined process. That's kind of another trait that I have in general, is like most of the things that I do, I want to systematize it and I want to have a process so that I can identify what's working, what's not working. I can remain objective. So I was doing that all through college, went to the Marine Corps. I did my MBA while I was in the Marine Corps, and I essentially traded the entire time. I just had to change the way I traded.
Right.
Because if you're going on a deployment or if you're going on like an exercise, you're not in front of your computer for quite a while. So I would set up different strategies, specifically diagonals or the coverage triangle, where it's something that I don't actually have to interact with that much if I don't want. You give up some of your profit potential by interacting with it less. Sometimes you actually gain a little bit by interacting with it less.
Yeah.
But I tried to create variable strategies that allowed me to bend as I needed to for work.
Oh, so you were trading all through your entire service?
Absolutely.
Oh, wow.
Yeah.
Okay.
Yeah. Like I said,
That's so cool.
I'm a junkie about this stuff. Yeah.
I can tell what you mean by earlier you said you get like addicted.
Obsessive personality.
Yeah.
Yep. Especially something like this, when I started realizing trading it reminds me of like surfing, where there's a bit of a skill gap. People that surf and they're really good at it, they make it look effortless. Yeah. They're just out there floating on the water. And I remember the first time I tried surfing, like literally just sitting on the surfboard was kind of tricky.
Hey,
and
at least you can sit. I can't even get up.
It's tricky. And I mean, I'm pretty athletic. So like I typically am used to being able to do physical things pretty reasonably quickly. Okay. And so I tried surfing. I was just like, yo, I got to figure out how to sit on this thing. But the main point is you see all these surfers, and not even like these old surfers. It's like these kids. They're tiny and they're just crushing it. Yeah. And you just completely misassess how much effort went into where they were at. Trading is the exact same. You see people that do it, they do a good job. Yeah. They can see things that you might not see. A lot of that comes from baked in pattern recognition in the subconscious mind from just looking at stuff for so long. But I think trading is fantastic in that it's accessible to everybody, but it's super misleading. Yeah. Because essentially what goes into trading is you save some money, open a brokerage account, you're now a trader. That's it.
Right.
There's no test.
It's too easy to become a trader.
Exactly. Yeah. There's no test. There's no exam. There's no prac app. There's nothing. Yeah. There's no interview. You just start. And it's one of the only industries that are like that. And what I try to get people to think about is like, even if you're going to go to a job, let's say you want to be an electrician, you have to figure out how to be an electrician. You go to trade school for a while. Or if you want to be a welder or pretty much any job that's out there, you have to do something to display competence before they will pay you to do it. Yeah. Yet all of us, we start trading expecting to get paid to do it right out of the gate. Yeah. It makes no sense.
You're skipping that college or apprenticeship phase.
Right. And on top of skipping it, you have massive expectations because we all think we're going to get rich super fast. Yeah. And it sets people up for a bit of a problem, I think. I had a question for you.
Yeah.
So when I came to Canada, I realized I'm in Canada now. Okay. Are you familiar with the Drake and Kendrick beef?
Oh, yeah.
Who's your pick? Who won?
I'm kind of indifferent, to be honest.
Indifferent? Yeah. I didn't expect that.
Yeah, I'm kind of just like watching and following the drama.
Yeah. It kind of slowed down, but the reason why I'm asking is because I asked the dude that brought me from the airport the same question. Oh. And he had the same answer, which was actually really anticlimactic. Oh, yeah. I thought you guys would be hardcore Drake fans, standing behind your guy, but nobody's doing it here.
No, I know he's Canadian, but then like he's not. It's not like he's doing stuff in Canada and for Canada all the time.
Oh damn! So you disown Drake. I like that.
Yeah. I'm kind of like, we're just like, oh, you're Canadian. That's cool. It's like Justin. Did you know Justin Bieber is Canadian?
I had no idea. I don't know anything.
See,
about
most people don't know he's Canadian. It's like him, like, because they kind of got famous in the States,
right?
So it's like, I think don't they have dual citizenship too, or something like that?
I think it's normal between U.S. and Canada.
Yeah. Like, but it's just like it's not like they are in Canada and doing stuff for Canada all the time. So we're just like,
Damn. So he's a fake Canadian.
yeah,
That's what you say. All right.
yeah.
Okay.
I like Taylor Swift more than Drake.
Of course you're a Swiftie. I think everybody's a Swiftie at this point, even if you don't want to be.
She has the tour in Vancouver is sold out in like seconds, and I'm like, oh, I can't get tickets. And the tour,
That's crazy.
Yeah, I know. I'm like so upset.
They're literally postulating that like her movements affect the local economies of where. It's almost becoming like Olympics level, which is nuts. You're gonna see like cities spiking up because of her.
Yeah, I believe it.
I could, yeah.
I'm still upset that I can't go.
Let's sneak you in.
I don't think that works.
Honestly, they probably have crazy security.
Yeah, I don't think that works.
That probably does not work.
Yeah, I think you're not the first person to have thought of that.
Yeah. I guess. Pretty unoriginal.
Could you share with our audience your experience of your biggest win and biggest loss in trading?
Yeah, the biggest loss is far more interesting, actually, I think.
Okay.
So it was when I was trading for 5 years at the time. And the reason why I emphasize that is for a few reasons. Based on most of the data that I could find, again, from like SSRN, the 5-year mark is a really important threshold for traders, where that's at the point where the highest dropout occurs, and it's something to the tune of 93% stop trading within their 5 years. And again, like people throw out crap statistics all the time, so I would highly encourage everybody to just go to SSRN and look at some of these for yourself, just so that it's not another, say a number and repeat a bad number.
I see.
But yeah, I'm pretty sure it's 93%, and I think happens for a bunch of different reasons. And then interestingly enough, there's actually a small cohort of people that proceed past the 5-year mark that still aren't profitable, which I need to find one of them and talk to them, because that's like just psychotic to me.
I know a few.
Yeah, really?
Yeah.
I'm so curious. Like, I need to know what's going on in their mind.
Like they love trading, the game of trading more than making money at that point. But anyways, sorry.
That's just crazy to me, because it's like the way you assess your proficiency at the game is how well you. Anyways, yeah. To your point, I guess some people are crazy. But thinking about that threshold, I fit the profile almost perfectly. And there's an effect called the Dunning-Kruger Effect.
Yes.
Yeah. So you guys are familiar with it. I won't go too far into detail then. But suffice it to say that there's a really dangerous period in everybody's learning of something. And in this case, I'm going to talk about trading, where within the first, few years, you essentially, you don't know anything, and your confidence is low.
Yeah.
So makes total sense. Then you go through this really aggressive learning phase where you're spending tons of time, hours and hours and hours. You're reading everything you can find. And then you feel like you know something because you put in a ton of effort. You do know something. That is kind of the peak of the Dunning-Kruger effect. And it's where you're most vulnerable. It's where you're most prone to make big mistakes, like I did. So at the 5-year mark, I had been trading for a long time, obsessed with this stuff for a while at that point. And I was trading a really wide iron condor in the Russell 2000. So the RUT, the index itself. And the whole point of this iron condor is it's a defined risk trade, but I traded the wings really wide.
Like the range? Really
wide? So the range was big, but the protection wings were super far out.
Okay.
So what that does is it gives you a better profit potential, but it gives you higher loss potential as well.
Okay.
So I put on this trade, and at origin, it looked great. It was a really high probability trade. I want to say it was over 70% probability. So I was just like, yeah, this is like free money. And I went to the gym, and as soon as I got to the gym with my buddy, it was a couple days later, I looked at the phone, and the trade on the account is still the largest percent drawdown that I've ever had. It was over 30% drawdown of the entire account on one single trade. And I was looking at it, and thankfully, I didn't freeze. I just closed it. And I was like, I didn't think through any of this, essentially is what that boiled down to. What it came down to in its short form is I never sat to truly consider the possibility of it not going against me. Like, how egotistical is that? I put on a trade that was high probability. I thought that, I knew everything I was doing. I put this thing on, and at no point was I sitting there genuinely considering how it could go against me.
I see.
And then it did. And my favorite part about that story is after I close the trade, I obviously monitor it, and it would have been a full profit if I didn't close it.
Don't.
So I literally
It always works like
I literally
that way.
blow up a third of my account, and then I'm just like, and it would have made money. But that was probably one of the most pivotal points in my trading career, like it is for most people.
Yeah.
And it was at that point that I decided to get really, really serious about what I was doing. And rather than just like reading and half-heartedly attempting things, that I was going to get really, really focused and organized so that there's no more room for these ridiculous errors.
Yeah.
And that's essentially the worst trade that I've ever had. And I remember it fondly.
And to your point that you mentioned earlier, even if you had gotten away with that one time where you got
Right.
full profit, you would do it again.
Absolutely.
So I think, yeah, it's good that you had that lesson earlier on.
Yeah, I look
Yeah.
at that and I always say like risk is going to be realized.
Yeah.
And that's exactly what that was.
Yeah.
The risk was realized.
Was it on an individual stock or SPX?
It was on the Russell, so the Russell 2000
Oh, okay.
index. So there's SPX and then there's RUT. It's essentially the Russell 2000 equivalent of the SPX. The reason why I
I
like
see.
the Russell a lot, the small caps, is a few reasons. Typically more volatility in them, but there's actually way better diversification within the index. People now are so used to the S&P 500 just
Yeah.
flying off the handle or the Qs
Yeah.
because tech has been so hot for the last decade. But believe it or not, there was actually a lot of periods before that where small caps outperformed large caps. That's kind of the idea of growth. So that's why I was in that product, and I still trade those products a lot now.
So let's say if a new trader who is interested in learning options, right? We talked about earlier, a lot of people jump straight into the
You pick a
scalping
strategy
or
and just
the-
start. Yeah.
Yeah. So how would you recommend someone to start learning about options? And do you think it's necessary for them to at least have some understanding of stock trading first before looking at options?
That's a fascinating second part of your question, and I'd have to think about it because I'm actually not
okay.
sure that it matters that much if
Oh,
they're
really?
familiar with stock trading. Yeah, I think it could work just fine, and I think it could also work just fine if they didn't. So yeah, that one I don't necessarily have a significant opinion on one way or the other. I guess
Okay.
the way I would kind of take the cheating answer is if they were good at stock trading, then I bet they'd probably be okay at options trading.
Did not happen
But-
to me.
Yeah. Well, that's probably because I would imagine you weren't applying the same things that you were doing in stock trading to options trading. Because, for example, if when you made your transitions from whatever you were doing successful in stock trading and you just started buying options that were really deep in the money, like a 90 delta or even a 80 delta plus, but you did everything else the same, you would essentially have a hard time performing worse using options in that format than the underlying itself. So my
Yeah.
guess is when you made the jump, you probably changed a few other things.
Yeah, I was trading more of all the money.
Aha.
So not
there we go.
not
Yeah.
deep in
yeah.
the money.
Yeah, exactly. And
Okay.
that's really alluring to people, right? Because
Yeah.
it's cheaper. You get way better percent compound returns,
Yes.
but everything in trading, it's give and take. What you're giving away in that instance is you now have a higher movement required in order to make a meaningful amount of money. And it's a lower win rate trade. So
Yeah.
that's the trade-off there. But anyways, yeah, essentially if you had used options as a stock replacement as compared to using it as a compounding tool, I actually think you probably would have had a great experience. But I think the main thing I would consider for a new person that's interested in trading options is the very first thing is they're complex, but once you understand the rules to the game, they're not that bad. They're really not that bad. The problem, though, is that people jump in head first and they don't realize how many ways you can get hurt trading options that doesn't really apply to trading stock. So to summarize some of them, if you buy a stock, you're holding an asset. You're holding the asset itself. With options, you're holding a decaying right to do something with the asset if you
Yeah.
buy them. So not only when you trade options, you're now adding a time component, you're adding a volatility component, and you still have the same directional component. You have an interest rate component.
Yeah.
You start to think of it like, why am I doing this again? This seems to add a lot of complexity.
Right, yeah.
But the markets are cool like that. There's a payoff for things like that. So the very first step, I think, is to grab a copy of Options as a Strategic Investment by Lawrence McMillan. I know Larry in a very loose sense, and that I've emailed with him a couple times. Like, I'm not affiliated with the dude, but he's a really good comprehensive text. And it's at a medium level. Natenberg is another great book author that writes a great book on options trading. But the most important first step is, rather than immediately start trading, my recommendation, make a syllabus for yourself. What other thing do we learn that you just start randomly doing it with no structure whatsoever about the pieces that you're learning, the foundation that you're laying, and how you're going to grow from there? I refer to people when you go to kindergarten, there's a syllabus still. They call it something different, but essentially they have an outline for the things that you're going to work on. So I think for trading in general, but especially options trading, you need a freaking syllabus, because otherwise, how do you know you're learning the right things in the right order, focusing on the right stuff? I think that's the best possible place to start. And it's obviously most important to gain a theoretical understanding of the products, because there's a lot of nuances. Yeah. And then paper trading them as you're going along. I think those are the two easiest things you could do to get started. 3, I guess. Grab a copy of that book, start outlining a syllabus for yourself. The cool part is that book kind of does some of that for you in the beginning sections, and then start paper trading. I think people give paper trading a terrible rap, and I think most of those people are just undisciplined human beings that can't take it seriously, because it's not real money, and they can't take things seriously unless it's real money. And I always say, man, I'm thankful you're not in the military, because if the only time we get to train is when we're actually getting shot at, there's a lot of people getting killed. Yeah. So if you can't take paper trading seriously because you're undisciplined, you're going to run into a whole host of other issues that come from a discipline issue. So you can take paper trading seriously enough to derive benefit from it. It'll never fully replace trading, to be very clear. The psychology of having capital at risk is second to none. Yeah. But you can learn a lot of the stupid mistakes you're going to make without wasting money. You can build a data set without losing a bunch of money to build the data set if you're tracking your trades. So those are the 3 things I think most people should do. And the reason why I think building your own syllabus is super smart is because if you go through that process, and I mean, people can hit me up whenever they want to send me a syllabus. I'm always happy to take a look at it and say, you should add this, you should remove this. But if you have a couple people you can talk to about it, to just get a second set of eyes and say, hey, I'm thinking about learning how options work, what a call is, what a put is, how they're priced, what the Greeks are. Like, that sounds great to me so far. You're doing awesome. But if your syllabus looks like, oh, I'm going to learn what calls and puts are, and then I'm going to start figuring out what strategy I want to trade, that's not it. You're gonna have to do something else, because you're gonna have a lot of problems if that's your approach to learning these products.
Do you have an opinion on selling options for income? Or a lot of people call this like the passive income strategy.
Love that. I think it can work just fine.
Okay.
But I think, again, people make the same common mistakes, and people think that selling options for income is like this magic solution to something that it's not. It's entirely doable. You can sell options and collect premium. The problem is multiple fold. The first thing, when you sell options, you immediately are giving up your access to unlimited gain potential. Maybe you're okay with that. If you have a really developed account, you don't care about the gains anymore. You just care about collecting income from your assets. That's okay. Okay. The other problem is people with options get into this world of rolling options, and they think it's this magical fix, and it's probably the most frustrating thing I've ever experienced. It's kind of like if somebody looked at this wall and they were like, that wall is black, and you're like, no, man, it's definitely white, or whatever that is, white-ish. Right?
Yeah, I think it's white.
Yeah, it looks white-ish. Definitely not black though. Yeah. But if they're telling me that wall is black, I know it's not black. With options rolling, it is simply closing a trade, opening a new one. Yeah. You are mentally tying the accounting together. Okay. That's it.
So you're just delaying the loss? Is that what that means?
You're realizing the loss. Okay. But what makes it attractive to people is, let's say you sold an option for 50 cents. You buy it back for $1, so you have 50-cent loss, and then you sell your next one for $1.25. You get a 25-cent credit. That's a standard roll scenario. And to be clear, you can roll a winning trade. We just normally refer to it in losing positions that you're defending on the selling side. I see. And the problem with rolling is that people think that as long as you're collecting a credit, that you're okay in the back end and that you can roll into perpetuity. But notice what we just said. when you close that first trade, you've just realized a loss.
Yeah.
So your account liquidating value represents that new loss value. Then if you lose again and you roll again, your account net liquidating value has gone down again.
Yeah.
You are eroding your account value. Now, the ultimate payoff at some point is that if your end position ends up making money, you can recoup all of that money that you lost. If. The other thing, people forget that there's an opportunity cost to that capital.
True.
Was that the right spot for the money? Who knows? But people get really egotistical about their trades and not wanting to have losing positions, that they'll just keep rolling something that's not coming back. So I'm really careful about the way that I roll positions.
Right.
If I'm trading something like an index ETF, like IWM,
Okay.
I've never seen IWM not make new highs at some point. And I generally am bullish on the US economy. So I would roll that for a while if I had to, no problem.
Okay.
But if you're the person that got into GameStop when it was a few $100 and you're still trying to roll that position, well, one, you can't anymore. You probably would have gone insolvent at some point.
Okay.
But when something moves too far away, you can't physically roll it anymore for a credit without going super far out in time, yada, yada, yada. So I think that's a common problem when people are trading for income is you're giving up your profit potential, meaning you don't have unlimited profit. You're collecting a smaller amount up front. Then if your position is ultimately challenged, now you don't get the income from that last week because you have to give it all back, sell a new one, and we're hoping this next one works and covers the cost of the previous one. And that next roll typically won't give you the next amount of income that you need. So I see nothing wrong with trading options for income. It needs to be really well thought out. My recommendation to people, don't live spoon to mouth. The way I thought about becoming like a full-time trader that you can sustainably live off of is if I need to live off of this year's income to make this work, I'm already in a bad spot. So what I think makes way more sense is you figure out what your annual expenses are, and then you save at least an entire year, preferably 2 with a little bit of padding, and then start trading options for income to replace what you're taking out. But if you put yourself in that kind of dire scenario and this month's income is predicated on if you can sell this month's options for income, it's a tough way to make this work.
Yeah. But to clarify, you're talking specifically to the people who are selling for income. Okay. Got it. Okay. That makes sense.
Yeah.
No, I always kind of wonder because like,
it sounds great.
yeah, it sounds amazing.
Yeah, it sounds
passive and all that stuff. But
it's one of those things that sounds really good. But as you know, being in markets long enough, if something sounds too good to be true, it typically is.
That's very true.
Yeah.
If you could elaborate more on kind of what your trading process is like so our viewers can have a better understanding.
Yeah, for sure. So one of the things I think traders get into the habit of is overemphasizing any one single trade.
Okay.
And they forget that each individual trade is part and predicated on the system that we back tested and we know it's efficacious.
Okay.
I emphasize that because most people just start trading a random system. They don't believe in it, so then they don't follow the rules, and then they wonder why nothing's working for them. So predicated that we back tested something, we know if we follow this general rule set writ large, it will work, provide positive expected value. Great.
Okay.
Traders, when they put on that one individual trade, often become obsessed with that one individual trade and trying to make that one individual trade profitable. It becomes a reflection of who they are, all of the research they've done. This becomes a representation of their value, like as a human being. And this goes into a really interesting branch of human psychology, is I believe. I'm not a psychologist. I just study this stuff a lot. And I think for traders early on and in general, it is so important to treat each trade as part of a process that even if it doesn't work this time, if we are prioritizing following our rules that we know work, this time might not work out. That's okay. It doesn't mean you're a loser. It doesn't mean that you'll never make money. It means this one individual trade that you might have done everything right on still didn't work out. Guess what? Happens all the freaking time. So this process focused, I think, is one of the biggest unlocks for people, because then we stop having all of these issues around individual trades. If it's a loser, now I'm mad and then I'm revenge trading.
Yeah.
Or if it's a loser, now I'm gun shy and I don't want to put on another trade because that one was a loser. I think by developing this obsession with the process and constantly optimizing this system and the process of that system, you're way better off as a trader. Because here's the other thing I've noticed, at least for myself, and I imagine for other people. If I break my process, and to be clear, I do give myself right always. I always say the trader has the last say. So I do give myself the authority to break a process, but I have to document it so that it's always there on what I did and why I did it. But if you get into the habit, and like we were talking about before, you put this trade on, you're supposed to follow these certain rules, you break your process for this one trade because you don't want this one trade to be a loser. You broke your process and then it works. Positive confirmation. Broke my process in this instance. I overrode it. It worked. Maybe I'll do that again next time something's not going well.
Right. Yeah.
What's the process then? If you get into that habit, you're slowly eroding the very thing you took the time to build. And then it loses essentially all of its efficacy. So I think creating a more process-oriented approach really does people a lot of good, along with a slew of other psychological habits that I think traders, we talked about a bunch of them before, but I think another really important one for people is like this successful mental detachment from trading capital. If you look at the money in your trading account as that's a car, that's a house, it's really difficult to have an objective stance on what makes the most sense, because sometimes you have to follow a process through a bumpy patch that doesn't feel that good.
Yeah.
But you still have to keep taking your shots, but you're watching your account value slowly dwindle down, and there goes your house. Now you got to get a smaller house, and that sucks. And you just watch this process go down. You start to say, well, I don't want a smaller house. I'm done now. I'm not doing this anymore. And then again, you lose the efficacy of the system. So I think having a system, obviously, and then I think having a successful detachment, mental detachment from your trading capital. And there's a lot of different ways you can do that. A lot of it's reflected in the language that we use. But I think it's also coming down to when you have winning or losing trades, not feeling any type of way about it, which is really difficult for people because you want to celebrate your wins. Yeah. But what I tell people is that if I have somebody that is super excited when they have a winning trade, I'll show you somebody who's miserable when they have a losing trade. Just wait.
Definitely, yeah.
Very difficult to regulate. So I try to think about like the emotional disposition of a successful trader as just a steady ship going through a stormy sea. And it might rock a little bit here and there. We all have emotions. It's not trying to deny our human emotions, but it's making sure that we have successful regulation over them so that we avoid these emotional roller coasters and then thus the poor decisions that come with it.
I think that also takes some time and experience.
Massive.
For some traders, for most traders to get to that point.
Well, I was actually going to ask you a question on that in like the world of day trading. So would you surmise that the number of trades that you go through helps you or hurts you in terms of your ability to emotionally regulate?
Do you mean like in a single day?
Or a series of days? Yeah. Really what I'm highlighting is just the frequency of day trading.
Oh.
And I'm curious if you think that frequency helps or hurts somebody's ability to emotionally regulate.
I would say actually for me and for a lot of traders I know that trade like me, momentum trading is kind of what I do. The more trades we take, the more usually leads to more mistakes. Usually the best days are where I'm only trading like 2 trades.
Got it.
Yeah.
Yeah. And then do you notice like if you're trading not too much or a lot more, like your emotional state, does it change?
I think it depends on if I'm trading more because there's a lot of opportunities, then in that case it doesn't change. I'm just still just trying to, take advantage of the opportunity. For example, like GameStop, a couple of weeks ago, I traded that thing the entire day. But I wasn't more excited or more sad during that day.
Right.
But if it's a day that say, I used to do this a lot where I'm already in the red and then I'm just trying to make that money back, then I trade a lot more and I get a lot more flustered and a lot more frustrated.
Yeah.
Yeah.
And then it's that emotional,
Yeah, for sure.
And it's funny that you highlight the process of like being in the red too, because again, like that goes back to the detachment of trading capital, but it's also like a reflection of the performance. But even in those instances, like if we have confidence in the system because we researched it well, we know that losers are part of the game.
Yeah.
And I have a saying where I try to maximize my losers. So I'll look at a losing position, and the most important thing for me to analyze there is, did I do what I was supposed to do? And if I did what I was supposed to do, that's actually still a losing trade. Let's not make any mistake. You don't get to say, oh, then it's a winning trade. It's not. You lost money. But if I did everything that I was supposed to do based on what I laid out, it's a great repetition in doing something that's right for you that sucks. It's like if you have a good diet. Sometimes it's not super fun to go eat the bland whatever because that's what you're supposed to do. But if you get used to doing it over time, it becomes easier. And then next time you might find, your next losing trade isn't as big of a deal. You're like, this happens. It's all good. I trust my system.
Yeah, that's true. That trade in all the context we talk about, it's part of a process.
Exactly.
It's still a good trade, even though it lost money.
Exactly. Yeah. And that's like one of the most massive things I think that traders, they hear that all the time. Trade your system, trade your plan, trade your process. But the problem is like people don't go into like how to make a process, how to make a plan, which is some of what we talked about today. Yeah. And the reason why I think that stuff is so important is because if I make a process, I give it to somebody else, what's the probability that they're going to follow the process as they should? Probably pretty low. And it's because they might not understand why I put go left instead of go right. And they're like, oh, well, that doesn't make sense to go that way, so I'm going to go that way. The process of building a trading process is super important for you to be able to trust your own work. That's why I'm such an advocate of things like backtesting and paper trading, because you're not going off of a feel. I think this might work. You're literally going off of quantifiable data that you can look at. Now, to be clear, what I tell people is if you can't make a backtest look good, then you have a massive problem as a trader because it's so easy to make back tests that come out looking perfect. And it's also really important to be aware of things like overfitting, right? Where if your data looks perfect in a back test, it probably means it's not very robust or going to withstand future unknown market conditions. But the main point is even going through the process of quantifying your system. If your system is, I'm going to be a momentum breakout day trader, it doesn't mean anything. Like that literally doesn't mean anything. You have to define what that actually means. Yeah. And then you have to put data behind it. You can't just say like, oh, on these 35 charts I looked at, it seems like it works. What does it mean? Like you're supposed to do this for years and you're going to predicate an entire approach off of 35 charts? It's just so unrealistic that that would work out. So I think outlining the idea and rigorously testing it is what gives people the confidence to actually follow through with what they're doing. Because otherwise, how many people do you know make a plan just because they're throwing ideas out because they're supposed to have a plan and then they don't follow it?
Yeah. Most traders.
Yeah, we've all been there before.
Yeah. Do you have any final tips for our audience, for people who want to kind of start creating their own process and becoming more disciplined and not be so attached to the money?
Yeah, I think the main thing to think about with trading and to figure out something that works for you is twofold. The first one is from Stephen Covey's 7 Habits of Highly Successful People, which is begin with the end in mind. Okay. I think defining that. So I gave you one of my original end in minds, which was the Millionaire Roadmap, right? Yeah. Want to be a millionaire before 30. That gave me day-to-day purpose when I was doing the shitty things, when my friends were going out to hang out, they're going to the bar, and I was going to run and look at data. Not super fun. But it gives you kind of a way to accept that. And the second thing I think beyond beginning with the end in mind is don't mistake trading and the low level to entry. Anybody can start trading. Yeah. And I think that's why so many people lose a bunch of money is because they start trading and then they think they're going to be successful for whatever reason. And what I tell people is if you can't articulate clearly why you should be a successful trader clearly, then why would you be? So I think thinking through where we're actually deriving our edge from is probably one of the most important things early on. And then the last thing I would mention on that is slow is smooth, smooth is fast. We say that all the time. And the whole point behind that is in the beginning, we all want to make a bunch of money fast. And pretty much none of us do.
Yeah.
It tells you something. And the idea of trying to pursue that super aggressively in the beginning, you're putting the cart so in front of the horse that you can't even see it. So accepting the fact that even though it might feel like in the beginning you're moving too slow, you're probably moving at just the right pace, because it means you're not sizing things too big. It means that you're taking the time to build strategies that make sense. And then you're staying connected to the process as you go through this whole process. And all of that ties in to begin with the end in mind. If you have a good goal that you believe in that's very valuable to you, you become more willing to put in the effort. You become more okay looking at losing positions because now you have a well-defined system that you know works over time. It's exactly what I would think about.
Very good point. Yeah. I never thought about if they're in the beginning, the progress is slow, they're probably doing the right thing. That's a very good point, actually.
What I think about is, again, like even my drawdown.
Yeah.
I've already done the math to figure out how much that set me back and where I would be now if I didn't have that drawdown. And it's a reminder.
Oh, you did the math on that?
Yeah.
Oh,
and,
okay.
And I compounded it out. And the reason for that is because sometimes when we're trying to go too fast, we don't realize that even a 30% drawdown on your account has a massive impact further down the line.
Yeah.
So even though you might not be out there knocking super, triple digit return years all the time, if you're not having massive portfolio drawdowns, you're ahead of the pack.
Yeah. Where can people find you if they want to learn more about you and connect?
Yeah, for sure. So I'm on YouTube at ES Invests, and then I have a website at the same.
Okay. Are you also on Twitter as well?
I am reluctantly.
Okay, we'll put your handles on the screen. Thank you so much, Eric.
Absolute blast chatting with you.
I hope by now, after the episode, you realize how important risk management is and how it can help a trader achieve consistency. Remember what Eric said in a podcast, slow is smooth and smooth is fast. Following the right process matters more than achieving fast money and fast results in the long run. Eric also shared so much insight on traders' behaviors and the emotional pitfalls that even the most experienced traders are still dealing with. Maturing in trading is when you start to define a process with detailed data that you can track, as well as constantly backtest and review your trades. Feel free to comment down below any key takeaways you have from this podcast, as well as any questions you may have for Eric. If you appreciate Eric sharing so much of his knowledge, then please remember to drop a like down below. You can also learn from other successful traders with different trading styles and experience from the playlist over here.